Welcome to Market Call. I'm Morella Fernandez. Lorne Steinberg with us on the show today. He's president of Lorne Steinberg Wealth Management. He'll take your questions on global value stocks and high-yield bonds. Here's how to reach us. 1-855-326-6266. You can email your questions as well. marketcall@bnnbloomberg.ca. Lauren, thanks for coming in. Good to see you.
Great to be here, Marilla.
Let's talk about the TSX, which is shooting up 470 points last time I looked. So we took a holiday break, coming back strong. August is typically a quieter month. What do you think is spurring investment?
First of all, from our perspective, the Canadian market remains pretty cheap versus the U.S. market and still excellent profit growth. Sure, gold stocks are helping things out and that kind of thing, but oil's been weak. Nonetheless, we see great value, Morella, in everything from financials like banks and insurance. Railways are cheap. We still have companies like Loblaw and Dollarama driving great earnings growth. So pretty broadly diversified opportunities in Canada.
Do you see any knockoff effect from tariffs yet as far as the markets go?
So in general, I mean, of course, markets have been, up in a lot of places in spite of tariffs. And tariffs haven't fully filtered through. So consumers, some things are a little bit higher than they were, but consumers are not yet feeling a serious impact from tariffs. Also, despite the jobs report last week, let me say that the jobs market has been reasonable and wage growth has been reasonable, offsetting some of that. So not yet. I mean, if the tariffs keep on going at the levels that they are at the present time, for sure it's going to have a greater impact.
You're using reasonable in the face of tariffs?
Correct.
Got it. Okay. When you look at tariff policy, we have a 35% tariff that is in effect on anything that's not compliant under the current deal. What else are you watching as far as tariff policy moving ahead? So
first of all, of course, tariff policy has moved back and forth, up and down like a yo-yo.
Yes.
Exactly. And so our view is as we get closer to the midterm elections, which are coming upon us, in about 14 months or so, 15 months, if there's too great an impact on consumers in the U.S., we are fully expecting there to be some tariff relief. Also, some of these tariffs that have been, come up with against Canada and elsewhere, are waiting for, other countries to respond. And so and we're seeing a very muted response from countries like Canada, Europe, et cetera. So it's very possible those countries will, hand a carrot to Donald Trump and maybe tariffs will soften up. So, we can't invest based on what we think will happen to tariffs the next few months. That's impossible. We need to remain focused on, do we see long-term value in these companies? Because, things can change so quickly. I was going to say, despite the fact that we're doing well enough, given the tariffs, you still see a wall of worry being climbed. Can you explain that? Sure. I mean, you'd expect with all the tariffs and everything else, and my wife brings this up regularly, hey, what's going on, all these tariffs, are they going to hurt everything? The reality is corporate earnings, Morella, have been relatively strong thus far. We expect that trend to continue throughout the rest of the year. Also, as an offset to tariffs, we're seeing a massive amount of capital investment announcements coming out of the U.S. and elsewhere. Specifically, of course, large cap technology companies have already announced they're going to spend $350 to $400 billion on AI-related investments. Then there's a whole number of companies that are reshoring, bringing manufacturing back to the U.S., also adding to all of that. And at the same time, tariffs have been, of course, somewhat of a wake-up call for countries like Canada, EU, UK, et cetera. And those countries are already starting to come up with policies to, drive their own corporate, encourage corporations to invest locally to improve productivity. And that's also a positive. And so we're seeing values in a lot of different places, but we're pretty optimistic, I have to say. Got it. Okay, we are going to line up some phone calls and some emails for Lorne Steinberg of Lorne Steinberg Wealth Management, taking your questions today on global value stocks and high-yield bonds. We're back in a moment. Welcome back to Market Call. Let's go straight to an email from Lucy. She says, good morning. I have been holding Sony for the past few years. I'm a little underwater.
What does Lorne think about Sony for the next 12 months? We were just talking at the break that Sony used to be the name for your television, all your electronics, really, and that is no longer the case, hasn't been for some time. What happened to them?
Exactly. So, I mean, Sony got out of the, low margin commodity manufacturing businesses. And three of their major drivers today, of course, are Sony PlayStation, Sony Music, they're one of the larger music publishers, and entertainment, films and the like. All of those three divisions are, PlayStation has its ups and downs whenever the competitor comes out with a better mousetrap or PlayStation type box. Music publishing, they're well behind the number one player. And the film and entertainment business is a very up and down business. So, Sony's, we look at it and we say, we think they'd be better off if they spun off something like the music publishing business, completely different business, and try to refocus the business on PlayStation and related and keep the entertainment side of the business. That being said, it's not really that a cheap stock. There's a lot of earnings variability, and for us, we would sell it and look elsewhere.
Got it. Okay, let's go to the phone lines. Chris is on the line. He's calling from Victoria, BC today. Hi, Chris.
Oh, hello, Morella. Hello, Lorne. Thank you for taking my call. Lorne, I was hoping to get your opinion on Pembina Pipeline. I like the dividend, relatively low volatility. It's trended downwards recently compared to an Enbridge or a TC Energy. So maybe your opinion on the pipelines overall would be great. Thank you both and have a wonderful day.
Thank you for the question.
Thank you very much, Chris.
Pembina at about 51.39 today, so it's a little bit up on the day, but generally.
Sure. So let me first say, hey, the dividend's secure. It is a rock solid dividend player, like all pipelines, low growth type business. We prefer TransCanada Energy. And might look at Enbridge as well, partly because of U.S. policy and the change in the Canadian view towards building pipelines. So we think both of those companies could be serious beneficiaries, whereas a Pembina would not be. Listen, they're all solid dividend players and payers, and we'd be comfortable with any, but our pick is TransCanada.
If you are invested in Pembina, would you just hold on to it right now? Again, it is down 59% over 5 years, but generally hovering sort of under that or around that $50 mark. Or
Sure.
sorry, up 59% over 5 years.
We'd be comfortable holding it because the dividend is secure. You'll see some dividend growth over time, so it's the old widows and orphans kind of stock, I have to say.
Got it. Okay, let's go back to the phone lines. Sam is on the line. He is in Montreal today. Hi, Sam.
Good morning, or afternoon now. Thanks for getting my call. Morella and Lorne, can you give me your thoughts on CGI? I mean, right now, there's a price target of 175. They've been hovering around that 134, and there's all this extra contracts about AI being in a position for them to be successful. Do you see that going forward? And what's your price target for CGI in the next 1 to 2 years? Thanks.
Okay, thank you for the question.
Sam, thank you very much. So CGI is the large Canadian IT outsourcing company. They've been very, very successful over the years in gaining market share, making niche acquisitions. Actually been a very well-run company. For us, we don't find the stock cheap enough. And also, I have to say, the impact on AI, not sure it's going to be a huge positive for them. It may result in things like help desks and IT outsourcing rationalize and need more employees because they take over an organization's IT. So we're a little bit unclear, honestly, of what does the near-term future hold for that business. So we are not a buyer at this time.
Got it.
It has been a very well-run company, though.
Let's go on to Ross then. Ross is on the line from Windsor, Ontario with a question. Hi, Ross.
Hi there. Thanks for taking my call. I'd like Lorne's opinion on Celestica. It reported earnings about a week ago, and the stock price has increased quite a bit since then. So I wonder if it would be a buy now or just wait for more of a pullback. Thank you.
Okay, so Celestica is up to 194. 267 on the TSX, down today a little bit, $1.64. They did have a solid earnings report, so I'm wondering what you would do. Is it too high to buy at this point? Would you wait for the dip?
So Celestica has done everything right for the last few years, and we would say the stock is priced for perfection. We need to buy stocks where there's enough of a discount to fair market value to give us our anticipated upside. That being said, let me not punish management for having done an absolutely spectacular job. A great Canadian success story and turnaround story, let me say, over the last number of years. That being said, this is just too expensive for investors, for us to step in.
How much, people always think, okay, I'm going to wait for the drop to dip in then. For something like Celestica, which is already up there, how much of a dip would you wait for? Would you, if you see any dip, would you jump in? Would you wait for a dip to a certain, what would your price dip be?
That's a great question, Marilla. Thank you. It's not so much a dip in the share price from here to here. It's a question is what is the valuation? What do we expect earnings to be? And then if we buy it here, do we seriously think we're going to get a double-digit return over the next 5 years on an annualized basis? And so until we hit that point, we just have to stay away. And some stocks stay very, very expensive for a long, long time. BlackBerry was in that category. We never owned it on the upside and then didn't have it on the downside. But they were growing their earnings at a healthy clip, and it was, at a very, very steep multiple. So sometimes things are just expensive, and when they're in favor like Celestica is, then the multiple also keeps on expanding. And it's like I said, it's no knock on the company, but it's priced for perfection.
Got it. Okay, let's go back to the phone lines. Alfred on the line today from Mountain View. Hi, Alfred. Alfred, are you there? Okay, we may have lost him on the line, but I think he had a question about Berkshire Hathaway. And we will talk about, of course, the retirement of Mr. Buffett. The stock has wavered a little bit as a result. I think people have concerns that he's going to step aside, even though his Canadian counterpart is well trained. But it's down to 464. So more of a gradual decline so far this year, but still up 8% over the year. What's your forward take on Berkshire Hathaway?
So first of all, we own Berkshire Hathaway. Let me say that. Second of all, Berkshire Hathaway is really two different businesses. One is the insurance business, which generates all of the float, which has been used by Warren Buffett and Charlie Munger and now Greg Abel to invest and create all that value. The genius who's running the insurance side, Ajit Jain, he remains in place. He's done a spectacular job. Warren Buffett's credits him at every annual meeting. And so that's business as usual. Like anything else in life, there will never be another Warren Buffett, Charlie Munger. They were one-offs. What will Greg Abel be? He's been well trained, and hopefully they've chosen the right guy. I do compare it somewhat to Apple. When Steve Jobs had to resign for health reasons, there was never going to be another Steve Jobs. Tim Cook was a boring operations guy who came in and put his own stamp on the company. And now I'm reading people worried that what happens when Tim Cook steps down? Like, what will the next person be? I mean, great companies breed great managers. And so we remain very comfortable owning shares of Berkshire Hathaway.
Got it. Okay, we are going to take a quick break. Lining up more phone calls for Lorne Steinberg of Lorne Steinberg Wealth Management. Global value stocks and high-yield bonds is what he's taking questions on today. We're back in a moment. Welcome back. Thanks for joining us. We're moving to the phone lines. David is on the line from Toronto with a question. Hi, David.
Yes, good afternoon. Lauren, I appreciate your advice and expertise whenever you come on the show. I'm looking for a value stock with a good dividend. Rogers, TELUS, and BCE. I haven't owned them for years. I'm wondering if you would recommend any one of those, or if not, if you have another choice for me as a solid value stock with a good dividend. Thank you.
Okay, thank you for the question. BCE, the parent company of this channel under the Bell Media brand. Telecommunications generally have been struggling, right, to change their model up. Immigration has also been a hit on the mobile phones market, immigration toiling down. Between the three bigger telecoms, do you have a preference?
So let me say, David, the old cornflakes commercial was tried again for the first time. So you haven't owned telcos in a long time. It's time to step back in. Dividends are sustainable. We own now all three telcos. We like the sector from a value play. Also, pricing seems to have bottomed out, and we're expecting, some marginal improvement. Also, of course, cost structures have been cut dramatically. They are all somewhat different, but mostly the same. Of course, BCE has made its large acquisition in the U.S., and we'll get more color on that whole thing going forward, on the next earnings report. But we're somewhat optimistic because these shares have been beaten down so badly, Marella. And, that's what we look forward to. This industry is not going anywhere. It will have some growth going forward, but the pricing's improving. Earnings should pick up. The cost cuts have filtered through the system, and we are honestly bullish on the sector. Why
did you decide to pick up all three?
Well, they're also different. So, BCE is pursuing its strategy in the U.S., which we think is probably going to generate some reasonable value. TELUS has been the faster grower, and they've made a bunch of good moves outside telecom in general and created value for shareholders there. Rogers is more, I would say, of a question mark. They've got a great franchise. All their holdings in the sports business, I would say, are questionable, but worth a ton of money. So if they, look at the prices of franchises in all the major sports, if Rogers decided to divest that would create a ton of shareholder value. Not that it's happening anytime soon, but there is a reason to own each one.
And do you see a plan for capitalizing on those sports franchises that'll make them some good money?
I don't see it in the immediate term because it's a dual class share controlled company. So as long as the Rogers family, wants to have those trophy assets, not going to get sold anytime soon. But boy, the value of those assets has been skyrocketing.
Got it. Okay, let's go back to the phone lines. Dave's on the line from St. Catharines, Ontario. Hi, Dave.
I'd like to thank you for taking my call. Lorne, I was wondering about Royal Bank and where you see it going in the next year or so. Do you think it's a good call? Thank you very much. Bye-bye.
Okay, thank you for the question. Royal Bank has done very well. I'm just wondering, moving forward, what your expectation is. It leads the banks. It was hovering around 180 last time I looked. We'll pull the chart up now. Is there more growth for Royal Bank?
So let me say to Dave and anybody else, we don't make investments just for a 12-month period. We are very bullish on Canadian banks, very bullish on Royal Bank. Ongoing dividend growth, earnings growth, an extremely well-run company that has basically outperformed the S&P 500 for the last number of decades, and is conservatively run, somewhat overcapitalized like a lot of the Canadian banks, and lots of runway to deliver that 8 to 10% earnings growth over time, which should result in a 10% annualized return to shareholders, in our view, over the next 5 years.
So you would buy in even at $180 a share?
Absolutely.
Got it. Okay. Let's get to John. John's on the line from Kingston, Ontario. Hi, John.
Hi, Marella and Lorne. Lorne, what's the amount that you need to realistically invest in the bond market? And for those of us that don't have enough, what should we do as an alternative?
Okay, thank you for the question, John. Let's talk bonds.
Sure. So first of all, John, just to understand, we would recommend for individual investors to keep their maturities relatively short. So don't go out and buy 30-year bonds. Stick to kind of a 1 to 5 year laddered strategy, very straightforward. Every year a bond comes due. If rates go up, you take advantage of it. Otherwise, you've got 4 bonds at least locked in. So, very simply, if you're a do-it-yourself investor, Marella, you can probably buy individual bonds in units of $10,000 or so. And so, a 1 to 5 year ladder would be at least $50,000. And I would stick to having a couple of provincial bonds in there for safety and high quality corporate bonds. This is not the place to take risk. If an investor has, less than that, then I would recommend just going out and buying a 1 to 5 year, ETF that is invested in 1 to 5 year bonds, and you're not taking huge interest rate risk. So if inflation picks up, the price of your bonds is not going to get hammered and take a huge loss.
Got it. Okay, we are going to take a quick break. We'll have Lorne's past picks when we come back. Stay tuned for that. Welcome back. Let's go through past picks from Lorne. These are from June 27, 2024, so a little over a year ago. At the time, he chose Walt Disney, DIS, on the New York Stock Exchange at 102.17 US. It's now up to 119.35, so a 17% return upside, 18% for total return. Walt Disney has been struggling a little bit. The streaming part of it has definitely been struggling. What are they doing well to see the growth?
So first of all, Morella, they went through a major reorg, and streaming has turned profitable finally by the end of last year. So streaming is now on the upswing. That is a major growth driver. Second thing is theme parks has been the largest profit generator and remains so. And they keep on coming out with a new theme park here, licensing a theme park elsewhere, and people are paying astronomical sums of money, and then the speed pass to get through the lines faster. It's been a huge growth generator. Their earnings are coming out tomorrow. We're looking for pretty healthy earnings. And also, Disney is poised to announce a deal with their ESPN division with the NFL. And assuming that announcement comes out this week, which is expected, that would be a real game changer, because it would make the NFL a partial owner of ESPN, lock those two companies together, and sports is a huge driver of profitability. So everything is going relatively right. What they have to do is come up with a successor to Bob Iger, who's back in the chair. That's where the board has had a number of missteps over the last few years. And I think the world will be looking for an announcement on that issue in the next 6 to 12 months.
Got it. Okay, so that's fairly soon. Let's go to your second pick from June of 2024, Cisco Systems, CSCO on the NASDAQ. At the time, it was 47.45 US. Now it's up to 68.49. So a 44% upside in return, total return of 49% over the last year. Cisco, basically IT, what's been going on with them to drive this profit?
So Cisco's always been a great allocator of capital, increasing dividends, buying back shares, but having no growth. They returned to growth partly on the back of a $30 billion acquisition of a company called Splunk, and very much driving their cybersecurity business. And as any of us in the financial sector know and elsewhere, cybersecurity, unfortunately, is a massive growth generator. So Cisco's returned to growth mode again. That is helping them improve their margins, driving earnings growth. And they've always had such a huge amount of free cash flow, Morella. They made this $30 billion acquisition without issuing any more shares. So that acquisition is starting to filter through to increased earnings per share. It's business as usual. I mean, they're just a free cash flow machine.
And sorry, what is Splunk?
Splunk was a cybersecurity software,
okay.
Yeah, exactly, more or less, which they're integrating with other businesses that they have. And Cisco has managed to remain, number one in most of their top businesses and stay ahead of the competition and create a lot of shareholder value.
Got it. Okay, let's get to your third pick from last year, which is Yamaha Corporation, June 27, 2024. It was 3,786 yen. Now it's dropped to 983.60, a 22% downside return.
The recommended I think number is wrong, because it is only down about 22%.
It is only down about 22%. Okay.
So just to let you know, so Yamaha is the keyboard and musical instrument company. That's their largest business, musical instruments. Listen, disappointing earnings report. China's been very weak. It's one of their major markets. They're stuck having to sell excess inventory at depressed prices. Kind of nothing is going really well at this company, except they continue to generate free cash flow. They continue to buy back a whack of shares. And as they clean out these inventories and eventually when their markets turn around, they should be pretty well positioned.
Are you holding on to the stock?
We're absolutely holding on to the stock.
Got it. Okay. We're going to be back with Lorne Steinberg in a moment to take your questions today on global value stocks and high yield bonds. We're back in a moment. Welcome back. Let's go to the phone lines. Mario's on the line with his question today. Hi, Mario.
Good afternoon. Thank you to taking my call. And I would like to find out what's going on with Cameco, because I am with Cameco for a long time, and I would like to find out if I should sell now or keep on going the way I would like to go.
Okay, thank you for the question. Cameco did get a boost early on this year when people started talking nuclear reactors and uranium. It's at 103.11 today, so it is up 95% over the year and dropping sort of a little over the last few weeks. Forward looking, I imagine this is a company you would hold on to.
So we don't own Cameco, and I have to say, you know, of course, major uranium producer, all of the nuclear stuff that is going on. The question is always how much of that forward-looking earnings growth is baked into the price already versus what is the upside. We don't own it. If it were a large position, I would certainly be trimming it at least here, because the lessons of life are, especially for commodity companies, when the price is high, you better take some chips off the table and redeploy elsewhere. And so that's my general comment. If Mario's got a large position, I would be taking some chips off the table, because if you look at the long-term chart of Cameco, there's a lot of up and down, and that is reflective of basically every commodity company that ever existed. So lesson is take some chips off the table.
Got it. Okay, let's go to Ben, who's waiting on the line. He's calling from Kingston, Ontario. Hi, Ben.
Hi, good afternoon, Marella. Good afternoon, Lorne. Thank you for coming back with a couple of stellar reports on the past picks, great ones. And I appreciate your outlook on Apple with the AI story on and off. And I would like your outlook to the end of the year when they report the first quarter at the end of January next year. And what would, if any, price target? Thank you.
Thank you for the question. I love the specific question. Tell me exactly what they're going to say next year. So they just had their earnings report. They did very well on iPhones. I want to know whether you think that was from people buying ahead of time because they have expected tariffs. And then he mentioned that question that seems to swirl around Apple. What are they doing with AI?
So let me say that we don't own Apple. We own most of the other large cap tech companies, but not Apple. 50% of Apple's sales, Marella, are still the iPhone. And the trend has been people changing their iPhone less frequently because, you know, most people are like me. They'll, you know, read their local newspaper, look at email, text, and a few other apps, et cetera. And so we haven't seen like the big move to, okay, is there a reason to really change my iPhone? Also, you know, they're struggling with virtual reality. And I mean, I walked into an Apple store the other day and everything was busy except for the VR. It was dead. Nonetheless, listen, they're an incredible consumer products company. They are not a cheap stock, let me say. And up until the last quarter, you know, revenue growth has been, you know, fairly flat, believe it or not, over the last few years. So we are not a buyer of Apple. The whole AI side, I mean, I think Apple's trying to figure it out. Everybody else is moving full steam ahead, you know, times 10. And, you know, how will Apple be able to incorporate AI into the iPhone and its other products to make people want to buy the new one? I think that's still a huge question mark. But listen, they have the financial capacity to invest $100 billion like everyone else does. So, we'd be wait and see, but the stock is not a cheap stock for a company that hasn't had much growth.
People used to line up for the new Apple phone. Remember that? They used to line up for hours to try and get the latest edition, but they haven't had a lot of jump forward in the technology for people to get that excited about anymore. Okay, let's go back to the phone lines. Nazar's on the line today from Scarborough, Ontario. Hi, Nazar.
Hello, hi, Lorne. May I have your thoughts on Sun Life Financial, please? This life insurance company had reached almost $90 and is now trading at $84. I heard your earlier comments. You like banks. What are your thoughts on life goals in general? I'd appreciate your thoughts. Thanks very much.
Thank you for the question. So, Manulife, Sun Life, do you guys invest in insurance?
We own them both. We like Sun Life, and we associate these as being Canadian companies, and Canadian earnings still drive these businesses. Sun Life has very large businesses outside of Canada. They've got a growing business in India in a joint venture with the Birla family, and good long-term prospects there. They've got U.S. operations as well. The thing about life insurance, Canadians pay a lot more for life insurance than Americans do because we have no idea what the costs for these companies are. We have no idea what the commissions embedded in them are. So when people buy life insurance, it's being priced. There's no transparency. That's bad if you're a consumer of life insurance. It's fantastic if you're a life insurance company. So great growth, good margins, no reason not to own Sun Life. Dividend growth, earnings growth, and Canadians are still getting wealthier, and this is a growth place, and Sun Life has been able to deliver for a very long period of time.
Got it. Let's go to the phone lines again. Kevin's on the line with a question. He's in Kingston, Ontario. Kevin, go ahead.
Hi, thank you for taking my call. I would like your opinion on the TD Bank. Would you be buying it at these levels? And what's your outlook for the next few years? Thank you.
Thank you for the question. We'll pull up the chart for TD. TD has come back quite well since the fall of last year when it had a penalty to pay in the U.S. for some of its money laundering strategy. So it's at 158, up 27, almost 28% over the year. Do you expect it to continue to grow from where it is now?
So the answer is, first of all, we own TD Bank. Again, this is a company that's been able to deliver long-term double-digit returns to investors, the dividend being almost half of that, or roughly half of that. So you don't need a lot to go right in order to keep on getting great returns from TD Bank. TD Bank remains in the penalty box. Even though they paid the U.S. penalty, they are the 10th or 11th largest bank in the States, but they are restricted from making acquisitions in the States. So they remain in the penalty box, and that's going to impact growth probably for the next few years in terms of acquisitions in the U.S. There's not a lot of place to grow in Canada, with the 6 large banks. So TD is just going to probably build up some excess capital and pay it back to investors, probably by possibly increasing their share backs, and continuing to raise their dividend, but still remains a solid hold.
Got it. Okay, we are taking a quick break. We're going to be back with more Market Call in just a moment. Stay tuned. Welcome back to Market Call. Thanks for joining us. Let's get to an email written in by Charlie. Charlie says, would you be a buyer of Air Canada? Wow. Air Canada, pretty bumpy ride, right? I mean, their last earnings, I think, weren't strong because they've had to pivot some of their American flights. Canadians don't want to go there as much, and that was a drag for them. And the stock has been sort of low for quite a while. What is your take on Air Canada today at $18.75?
So Air Canada, Morella, from a financial standpoint, has been poorly managed for many years. I say that because they remain a BB credit rating, so below investment grade. And their history has been when things are going well, they buy back shares and keep a lot of debt. And then when you get a crisis like COVID, they bought back shares at 40 and then have to issue shares at 20, which is destroys shareholder value. So, I mean, for us to even consider looking at this company, we would have to see a change in management philosophy, really, to paying down a bunch of debt, keeping a stronger balance sheet, and being prepared for inevitable downturns, recessions, crises, whatever, and not being forced to, issue more shares and destroy value over time. And, if you look at the long-term share price, there's been, no value created in this company for a long, long time.
With the bounce back for the desire to travel being intense post-COVID, and I think still is pretty high, what has held them back from really advancing on that? Was it just they were in the depths for COVID, and so they're still having to work their way through that?
Well, so part of it is they had to issue a bunch more stock, so earnings per share, even if earnings go up a bit, they might be lower in per share terms. Second of all, they're saddled with a bunch of debt and paying those interest rates. And the airline business it's a really tough business to improve margins because you don't have much of a brand. Consumers are shopping on Expedia and elsewhere just looking for the cheapest price. So there's not a ton of brand loyalty, even with the Aeroplan loyalty programs and all of that. There's some, but it's very much a commodity type of business as people are going to these third parties like Expedia and others, Kayak, et cetera, and just shopping for the cheapest price. It's a tough business.
Got it. Okay, let's do another email from Martin. Martin says, can I get Lorne's thoughts on Firm Capital? Thank you for the question. Firm Capital.
So Firm Capital is a Toronto-based company. They're one of those alt mortgage lenders. Their average loan that they give out is a 10% loan. And even though they say the bulk of their mortgages are first mortgages, which they are, people should not get confused. These are not mostly first mortgages on individual residences. They are mortgages mostly on construction loans, on land that are bought by developers and that kind of thing. So certainly much riskier loans. They've been able to maintain an 8% yield, so they are a pure yield play. And but every time they need to grow, they keep on issuing more stock, so you're not going to get any gain here in terms of capital gain. Hopefully if the economy remains stable, they'll keep on being able to minimize their bad loans. It's somewhat risky from that perspective and really not much upside. There's the better financial companies don't from our perspective.
Got it. Okay, let's go back to the phone lines. Frank is calling today from Mississauga, Ontario. Hi, Frank.
Hi, thanks for taking my call. I believe the guest had in the past recommended Diageo. I wanted to get his opinion on it going forward. They reported results, I think, this morning, which weren't that bad, given all the geopolitical things are going on, and they're committed to a lot of savings going forward. So, what do you think? Is it bottomed out and a good purchase at this point to do a DCA on it? Thank you.
Thank you for the question. This is a company that does alcohol products.
The largest, sure, they bought the Seagram's brands, 25 years ago or so. They're the largest distributor of what they call premium alcohol. And so it used to be Johnny Walker Red and Black, and now there's Johnny Walker Blue,
like 7
Green,
different
Gold.
kinds, yes.
And you'll always find a consumer to, pay an extra $50 for that kind of thing. That being said, so Diageo's run into a couple of things. We still own Diageo. We are buying Diageo. What they've run into, of course, is the health issues to do with alcohol. And so that has caused, a number of demographics to at least cut back on alcohol. That's having some impact. Second of all, they had some distribution issues. They replaced their CEO recently. And so, as the caller said, we're expecting them to rationalize the business, really focus more and more on premium and super premium brands. But I have to say, this is the best company in the world at what they do. It should remain somewhat of a growth company. And, when do you buy these great businesses? You buy them when they're on sale.
Got it. Okay, that is all the time we have for phone calls and emails today. But stick around. Lorne will share his new top picks after the break. Welcome back. Tomorrow on Market Call, Matt Kaser will be on the show, president of FSA Valuation Service. He'll take your questions on North American equities. And if you miss Market Call, you can check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for Lorne's top picks. His new one is Universal Music Group. Let's talk about Universal Music Group and why you think this has some growth moving forward.
So it's got huge growth. So Universal Music Group, Morella, is the largest music publishing company in the world, at least 50% larger than the next largest. They own the music from everyone from the Beatles, Drake, Taylor Swift, Rolling Stones, Lady Gaga, U2, you name it. And music is a huge growth business and a huge free cash flow business. So more and more, companies like Spotify have had to raise their prices to pay Universal Music more money. So just profit growth from existing businesses. Two, increased exposure from video gaming, fitness, social media. We're seeing music incorporated into so many of these different places, and every single time there's a snippet of one of those songs, of course, UMG is a beneficiary of it. So cash flow is growing in a significant way. It is a unique business. You can't copy it. We've seen in the past artists sell part of their catalogs for huge amounts of money. Well, Universal Music owns the other part of that catalog. So if you just put a valuation on all of those different catalogs, you come to way greater than the share price. This is a double-digit grower. It's not as well known in North America, but they're about to get a U.S. stock listing. And that U.S. stock listing, which has been pushed by an activist investor, Bill Ackman, so that U.S. stock listing should get them way more exposure, way more coverage, but investors have the opportunity to buy truly a unique, fast-growing business with no competition for those specific 50 labels, et cetera. At a very cheap price. You're also picking up a 2% dividend yield along the way that should grow over time.
Got it. Okay, let's get to your next topic, which is Unilever, food and consumer giant, of course. Very well-known name. And what are you seeing moving forward for them? They own a couple of very well-known brands, Dove, of course, being one of them.
Hellmann's mayonnaise, Knorr, et cetera.
Vaseline, yes.
And Ben & Jerry's, and et cetera. So first, a couple of things. So Unilever, again, has been under new management, has become a growth business finally once again. So earnings are growing, margins are growing, their cost structure is in fantastic shape. They're in 190 different companies. I mean, the country's an incredible operation. Second of all, management is spinning off the ice cream business into a company called Magnum's. Magnum's a huge brand in Europe. Here we know Ben & Jerry's, et cetera. The ice cream business is a completely different business because you need a different distribution channel because everything is refrigerated. So it should do much better on its own. It should also create a fair bit of shareholder value for investors. And again, an activist investor went in there several years ago, and this company has suddenly started to move. Investors today are buying this company for 17 times earnings, a 3.3% dividend yield, and we should see healthy earnings growth. It's probably one of the fastest growing consumer products companies in the world.
What would you say benefited from the activist investor? Meaning, what did they change to get to the part where they're growing again?
That's a great question. So I'm not always a fan of activist investors. Let me say a lot of them are very short-term focused. In this particular case, it was, get rid of a couple of brands that are stagnant, that are probably best managed elsewhere, like the tea business, and spin off the ice cream business because there is really no synergy there with ice cream and the rest of Unilever. If a truck goes around and drops off a bunch of different products, ice cream's not going to be part of it. It requires a different truck. So from this perspective, this activist investor, I think, has spurred the company on to really re-looking at this business and saying just, large is not necessarily better, and, take out the pieces that can be better run by someone else, collect great value for them, and focus on what you do well. So that was the focus when the board got regenerated. and the new management team came in. And it's been a long-term process, let me say, that is finally paying dividends.
Okay, let's get to your third pick because it's an interesting one. It's Nike, which is also trying to recover from a misstep with their go-it-alone approach, and now is trying to woo back, I guess, the retailers that used to carry their product to carry them again. You see this turnaround attempt as being positive.
Sure. So, first of all, Nike is the largest footwear, largest sportswear company in the world by far. Pristine balance sheet, almost zero debt, and even at the depths of pain, still ongoing free cash flow, share buybacks, dividend payments. So they got rid of the ex-CEO who was the guy behind the go-it-alone approach, which was disastrous. And they are once again, and they're able to woo the retailers need them. Badly, companies like Foot Locker need Nike, need the branding. Nike's been reinvesting a lot of capital into really reinvigorating the product line. They've run into competition, of course, from companies like On, which has gained market share. But when you're the largest in the world at what you do, Nike has the money to come out with very competitive products. They're also cleaning out, past inventory, and that's been a problem for earnings. It will continue to impact earnings for the next couple of quarters, but over the next couple of years, we expect earnings to literally at least double for this company, revenues to get back to growth, and again, investors have the chance to buy the best in the world when it's on sale.
All right. We have to leave it there. Lorne, thanks for coming in.
Well, thanks so much.
Join us tomorrow for Market Call, and thanks for joining us today. See you then.